Hello, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. With the first half of the year behind us, let's start with the scorecard. During the first quarter, returns across the fixed income markets were pressured as core inflation accelerated and job growth surprised to the upside. However, yields have dropped and remain below 2024 highs as inflation data has eased and economic growth has started to cool. Still, Treasury yields remain a bit higher than last year, with intermediate treasuries and corporates showing positive year-to-date returns, while municipals are slightly in the red, giving back some of the strong performance from the end of 2023. The clear winners so far this year have been in the high-yield sectors, where credit quality has remained resilient as issuers have been able to successfully navigate the higher rate environment and high absolute yields have drawn investor demand. As we look to the second half of the year, our focus now turns to the Fed. As expected, at the June meeting, officials left rates unchanged for the 7th consecutive meeting. While acknowledging progress toward the stated 2% inflation objective, the Fed continues to remain concerned about inflation. But more importantly, it reduced the number of expected rate cuts from 3 to 1 for the remainder of the year. In addition, Fed officials once again revised their estimate of the longer-run Fed funds target rate, from 2.6% in March to 2.8% in June. We view this as a significant adjustment and believe it reflects structurally higher interest rates over time. From a macro standpoint, we continue to expect moderation across a number of economic measures that will lead to slower economic growth driven by cooling labor, a more budget-conscious consumer, and easing inflationary pressures. The latest jobs report clearly showed cooling as prior months' numbers were revised down. This, combined with an uptick in the unemployment rate from 4 to 4.1% and moderation in average hourly earnings, shows that policy is restrictive, helping make the argument for rate cuts to begin. Despite Treasury yields being higher on the year and uncertainties surrounding the timing of Fed rate cuts, one might expect that investors would be cautious about adding to their bond investments. However, as you can see in this chart, flows into fixed income mutual funds have turned positive for the first time since 2021, with about $114 billion coming into the market. Higher yields are attracting capital, and investors are growing more comfortable with elevated rate volatility. The risk-reward in fixed income has improved substantially. Bringing this all together, we believe the data will support the Fed being able to cut rates later this year, with the first rate cut coming as soon as September. And as we approach a turning point in Fed policy, history shows that investors may benefit over the long run by pivoting away from cash and extending the average maturity of their fixed income portfolios. With our expectation for credit quality to remain resilient and high levels of income to provide a cushion for market volatility, yields remain attractive, with investment-grade corporates north of 5%, tax-adjusted municipals close to 6%, again reflecting the benefit municipals have for investors in high tax brackets, and the high yield markets yielding close to 8%. Thank you for joining me today for the Fixed Income Update.